tensions in the Middle East escalate.
What we are all seeing with our own eyes is a major attack from Iran.
It's a major attack, Dana, and it's an escalation. It's an escalation of this war.
We're talking about volatility.
Those sort of nightly bumps or the dips and all of the volatility that happens.
Hedging against volatility and market risks with our next guest today, Katara. He is the founder of TappAlpha, very interesting fund that he has that works when volatility spikes up. Thanks for joining us today, Sai. Good to have you.
Great to be with you. Thanks so much for having me.
Sai, let's talk about recent activity in the markets. What do you make of this heightened geopolitical tension right now? Is this going to cause more volatility into the elections, you think?
I think absolutely. I think we're sort of on the precipice of a big, global events. And global events have a significant impact on people's sort of fear gauge and willingness to sort of invest in markets and trying to find refuge for their funds. And so I think right now is a really interesting time with geopolitical tensions. But the question is, what do you do as an investor when you're dealing with sort of increased volatility in markets? And one of the answers is finding a good way to hedge. But also, if you're a long-term sort of buy and hold investor, the shorter-term blips ultimately, in some ways, don't have to impact your strategy. And so that's actually where some of the products that we were focused on really help benefit long-term buy and hold investors, as well as providing a potential hedge in economic climates like this, especially when there's uncertain geopolitical conditions that are out there.
We're going to talk about TSPY. The name of the fund is TSPY, ticker TSPY. Very interesting product, and I like to get a sense of how it works and how investors can use it. Let's go back to the markets and then come back to that. So the markets, the VIX is currently at 20. Huge spike up today on the back of the news in the Middle East. Nothing like what happened earlier in the summer in August when we had the reverse carry trade in the yen happening and global markets sold off. However, historically speaking, it's still relatively low compared to where it was in the past. Would you take a look at this longer term chart of the VIX and make the assessment that right now it's still the level of volatility is still relatively low compared to what it could be?
I would agree with that. And I think we should keep close eyes on this chart as we sort of march further into the political season. Upcoming election in November, I think is going to have some impacts here. Outcomes of that election, either way, I think will also impact the VIX directly, and then keeping an eye during geopolitical tensions. So we'll see it. But I think you represent it here visually really well. It's still relatively low and under control from a long-term perspective, but it's something to keep our eyes on. And one of the key things, depending on what your investing strategy is, I always find it very difficult to time the markets. And so my whole philosophy has always been, rather than timing the markets, it's time in the markets that makes a difference. So making sure our chips are on the table, we're investing and actually taking advantage of the long-term trends, I think is a really important component for depending on what season you are in your life. And so that's sort of those are the products, those are the focuses that we have as TappAlpha to make sure that people are taking advantage of the long-term trajectories, and being in the markets and being in the game is a really important piece, I think, of that puzzle.
You have a background in engineering, so I like to talk about tech stocks for just a few minutes here. Flipping over to a chart of NVIDIA, one of the leaders of the market in terms of market cap. It's been driving movements in both the S&P and NASDAQ. Take a look at the charts here. Over the past year, just in the past 12 months, it's up 160%. Now, what goes up comes in a straight line, usually comes down in a straight line. We haven't seen it come down in a straight line. It's just been stabilizing around the $90 to $140 range in the past basically 6 months or so. And that's been a little bit worrying for some tech investors. We're not seeing continuing momentum in one of the hottest stocks of the last 2 years. What's needed, you think, to drive NVIDIA to new all-time highs and propel the AI narrative even further?
I think partnerships are going to be really important for NVIDIA. And so you're going to see that across the board with some of the partnerships that they're making with multiple of the Magnificent Seven companies. And one of the things, too, it's hard. The what happened in November of 22 with the release of ChatGPT, it was really the beginning, I think, of the next huge era for technology. You can compare it to when, early 2000s, dot-com boom, seeing cloud computing explode, and then now AI, I think, is a whole new level. NVIDIA was visionary in a sense that they actually created many years of advanced technology that makes it more difficult for competitors to catch up, and that's what you saw in the upswing in NVIDIA stock. The other piece that's really interesting, I think, about NVIDIA is they are known as a hardware company, but it's their software SDKs and the packages that allow other third-party developers to create innovation and technology that connects to their hardware that provides so much differentiation. And so it's going to take some time for other organizations to catch up. So what does NVIDIA have to do now? They've got to build their moat, and their moat can come from two things. Number one, it's technology differentiation, and number two, it's business and partnership differentiation. So I think we're going to see a lot more partnerships from NVIDIA in order to sort of continue to increase their moat and sort of build on that competitive advantage.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Do you think their current partners, the large partners, Meta, Tesla, for example, have already finished their cycle of buying chips? In other words, from the hardware side, they've already acquired what they need and now they're maybe slowing down?
I think this is going to be an arms race, and I think the big dollar, large cap technology companies are going to continue to fight that arms race. And the biggest thing that they can do is invest in more of the technology, and hardware is going to be a huge part of it, and building software ecosystems around it. So I think this is just the tip of the iceberg. There's been tens, hundreds of billions of dollars invested in that curve. We're just at the beginning, I think, of first couple innings of this ball game, and so I think this will continue over time. And that's what gives, I think, a lot of folks the confidence in companies like NVIDIA to continue their growth. And that's why investors are sort of staying in for the time being.
You worked for Cisco in the early 2000s. This was after, I believe, correct me if I'm wrong, but I believe you joined the company after the dot-com bust. What were the priorities of the tech industry then? And how was that different than the priorities now?
Part of it was thinking about hardware innovation back then for Cisco. I remember I came down just before the year 2000 bug, and I was sort of on campus at Cisco, and the top execs were on campus sort of waiting to see what fallout would be with the Y2K bug. And thankfully, nothing big had happened. But a lot of the investment with the sort of dot-com bubble, when that industry went down, hardware sales went down, but that allowed everybody to take a breath and refocus on scalable innovation. And so that's what Cisco ended up doing, where they sort of split, their investment on building hardware, high margin hardware, but it's that software ecosystem that really drives value for the underlying hardware. And you're seeing similar things happen in companies like NVIDIA too. So I think that model makes a lot of sense. Cisco was a phenomenal company ahead of its time. Now it's sort of the next hockey stick when it comes to AI, automation, and driving efficiency. But there's companies that are still focused on cloud computing. Cybersecurity is going to be huge. And then we talked a little bit about global instability, but thinking about self-reliance in the global supply chain is going to be really important too, because you think about localized production versus semiconductor manufacturing internationally. That provides a huge variable that American companies, every company is going to have to sort of battle against. So those are three big trends in technology, I think, that we're going to see, particularly in a world where geopolitical tensions are sort of rising.
Okay, I have to point this out. Market bears have used Cisco as a poster child of what happened to the tech stocks, or one of the hottest tech stocks of the time. So this was obviously the tech bubble burst in 2000. Now, what's surprising is that Cisco took Wow, more than a decade and a half to
Mhm.
not even retrace its then all-time high. Now, a lot of tech companies, most of them have been hit by the bust. But if you just take a look at Alphabet, for example, it has more than beaten its previous all-time highs. I can
Mhm.
go on and on. Basically, my question is, do you think any of the current Mag 7 stocks uh, will face a similar fate as what was then perceived as the strongest, one of the strongest tech stocks of the time, which is to say, in the next bust, whenever that may be, crash and then not pick up again. It basically, are there any tech stocks right now that you would flag as having danger in their business model?
I think it's impossible not to, when you're at that size, think about innovation and being nimble. And so that's the biggest risk. And that's what you saw in Cisco, that you'd hope that the Mag 7 stocks don't also repeat. It's this idea of being nimble where there are business models that are directly going to be disrupted by the next AI move. So think about Google. Its main sort of differentiation has been they own search. But now people are going to other AI models instead of Google to get the answers that they want from a more comprehensive response system. And so it really depends on those big companies' ability to sort of dig back in to their startup roots and remember what it's like to be nimble in order to identify and play red team to say, hey, our biggest businesses are now threatened by what's happening with this new curve in innovation. And if we don't make changes and if we don't have actually internal models and processes to sort of continue to innovate, we're going to suffer the same fate. And that's really going to be the differentiator for companies moving forward, especially when you're this big. It's hard to turn large ships quickly. But if you can actually split off and create many small ships, they can be much more nimble in order to sort of ride the waves that are coming next.
What do you think is going to drive monetization B2C, B to consumers, for the AI companies or any tech companies engaged in AI, which is most of the big ones right now? Is it mostly going to come from the hardware side, or are there going to be software developments?
It's going to be a software play. I think the thing that bridges the gap is going to be application and implementation to solve direct business problems for consumers. And that's the game changer. And I think a lot of it's going to be sort of the freemium model before things become, for pay. We're going to put a lot of innovation and technology in the consumer's hands, gather data, sort of iterate and actually modify things in order to create whatever the business models are going to be. So you see that now with Gemini, you see that with Google, you see that with Microsoft, where they're like, "Hey, try this AI component now. You can access AI directly in your browser bar." It's bridging the gap with software in order to enable people to solve problems that they have. The problem sets and the places where this can be applicable are unbelievably wide, but the highest value ones, it's going to be an iterating process in order to figure out what consumers are going to focus on first.
For tech investors, should they be worried about declining margins in the rise of competition? For example, in the latest iOS, as you know, they're going to start rolling out their partnership with OpenAI, and there's going to be an integrated, basically, ChatGPT into the iOS system. You know, Apple's tweaking it, of course. But then why am I paying for ChatGPT if that's going to be available for free if I get a new iPhone,
Yeah,
right?
it's when it depends on where you're sort of measuring the margins too. So there's market margins with respect to what sort of premiums you can command in the space, but there's also internal operating margins. And one of the things that AI is providing to every tech company is this unbelievable acceleration in productivity internally. And so you look at groups like Google, Apple, they have some of the best engineers in the world. And now all of a sudden you're equipping them with other artificial intelligence tools that takes all of the minutia off their plates and it puts those brains to work in ways that are much more productive than they were 2 3 years ago. And so on both sides of the coin you're going to see those sort of efficiencies happen, and I would argue that potentially those margins are going to grow over time because of the internal operating efficiencies that big companies are going to be able to enjoy.
Well, that's interesting. When I asked you my earlier question about hardware versus software, I bring that up because Mark Zuckerberg recently made a product release about his vision for glasses going into the future. And he actually projects, or he believes that in the future we'll be using, we're interfacing with smart glasses, AR glasses powered by AI, more so than our phones, which in his product demo he says that it'll just stay in our pockets more. we interface more with something on our face.
Mhm.
I don't know if that's going to. I'll let you comment on that. Is that direction a game changer, more so than the software component, like you said?
I think the way I always think about hardware is sort of the foundational enabler for the things that the software is going to bring to it on top. So you remember when when Amazon first released the Kindle, they released it for less than it cost to actually manufacture because the hardware was just an enabler as a content delivery system for how they actually really made money. I think the same model is going to apply with respect to all wearables, all integrated systems like that, where you'll have new hardware platforms, but those are just going to be the enablers in order to create brand new business models that are driven by software, which is going to be incredibly scalable in the future. That's going to be the exciting piece on what are the different applications that you put on these different foundational pieces of hardware.
Okay, we'll transition into TSPY. Now, I ask these tech questions because tech has been a big component. We're a rising component in the S&P 500. Is that going to continue the trend of tech dominating all the other sectors within the S&P, you think?
I think there's going to be some cycles. There may be some pullbacks, but ultimately they're on the cutting edge of creating these unbelievable accelerators for their own industries. They're sort of drinking their own Kool-Aid while they're providing products to the consumers and to other businesses as well. So I think tech is best positioned to do so. But having said that, because AI and some of this innovation and technology is becoming usable by everybody, there are a lot of other businesses that are outside of technology that should also be able to benefit from the innovation that's coming. So, what I anticipate is tech's going to be driving it always, but the other components of the S&P 500 and industry in general will start to take advantage of the great multipliers that are now available by offering these kind of technologies in the market.
I'm curious to get your take on hedging against volatility. You came from a software engineering and tech background, and then you transitioned into fintech. I'm curious to get an engineer's mind on how market volatility should be managed or hedged against. What's your general philosophy there?
General philosophy is, as an engineer, you kind of take a huge step back and look at the playing field. And as an engineer, I also know strengths and weaknesses of myself, and I'm not smart enough to pick stocks. I'm not smart enough to time markets, but I can look at macro trends and sort of understand, what's my core philosophy and belief as an investor. And so, like you mentioned, I came from a technology background, but one of the things that I always did for my family was just buy and hold. I saved, and I took that investment and I just put it in the S&P 500. The SPY. S&P 500 beats 83% of fund managers that are out there just by doing the S&P 500. Biggest, baddest companies in the US and just letting it grow. And there's volatility over time, but over the years, I was so busy sort of running the businesses and being an engineer, I didn't have time necessarily to actively manage my portfolio. And those sort of nightly bumps or the dips and all of the volatility that happens, if you're a long-term buy and hold investor, you those sleepless nights go away. But one of the other things to answer your question, volatility is out there and it provides actually potential to capture additive income. And so that's one of the things when building this new company, TappAlpha, I wanted to figure out how to go and harvest that income that's available just because volatility makes it so. And I wasn't getting the most out of the shares that we own for our family. And so I developed a way to use daily covered calls to go capture that income and add, additive income that helped our family sort of make ends meet. And that's actually where the company got started was, the idea is, hey, how do we make these innovations, these strategies available to every investor and every advisor? And that's sort of what helped us start TappAlpha and then our first fund, which is TSPY, which we launched about a month and a half ago.
So the idea here is what expose a product to the underlying index, which in this case is the S&P 500, and then collect income on top of that. How does that work?
Yeah, exactly. So think of TSPY as a fund that taps the income potential of the SPY. So dollar for dollar, you own the same sort of equivalent shares of the SPY, the S&P 500, and then you add an additional daily potential income generation on top using zero DTE covered calls. So the goal is you hold the SPY, and then let the innovation, the technology, and the fund do the work to go out and harvest option premiums every day. And then those get distributed to investors on a monthly basis, which will have our first distribution actually later this week. And so that's the goal. It's really built for long-term buy and hold investors that actually want to tap into the potential of what they already have without having to do all the work because the fund's going to do that for you.
Okay, and there is a volatility component like we talked about earlier. How does a spike in the VIX benefit the fund?
Yeah, so option basically when the VIX goes up, option premiums go up. And when option premiums go up, that's more juicy returns that any sort of option-based strategy can go and garner and collect in the marketplace. So when you see the VIX go up, it just gives you more reward for the potential risk that's out there. And then what's great too, depending on the fund and depending on who it's really looking to benefit, you can either be a high risk taker and take bigger bites of the premiums that are available. Or in my case, I'm low to moderate. So I actually use the juicier sort of premiums to create a bigger buffer of safety. And those are the two ways that you can actually apply and use the increased volatility, which really has big impacts on option premiums for strategies like this.
What would you say would be the correlation coefficient of the T-SPY versus just the SPY?
I think it's a 0.77 or a zero point 0.8 ultimately. And you can think of it two ways. One, you can use it to sort of garner and aim for collecting more income. But the other is when markets are flat or going down, it actually helps you smooth out the volatility because every day you're collecting a little bit more cash, which pads any downside that you have to a certain extent. So that's one of the benefits in volatile markets like this, where if you don't want to ride the full ride, funds like TSPY can really help from a volatility perspective too.
I'm guessing then the beta to the S&P 500 would be less than one, meaning if the S&P goes up 1%, this would go up less than 1% and vice versa down.
And yeah, and obviously we aim to sort of bias it upwards with one of the things coming from technology, we built a fintech platform underneath it. And so one of the things that we do is we use that platform to be responsive on downside protection and making sure that when the stocks are going down, volatility is there that we can protect the downside, but then sort of letting things run a little bit when things are on the upside. And so it's that bias a little bit that helps us help with beta when it comes to how TSPY will perform versus just the SPY.
Well, how is the idea different than, let's say, a high dividend income fund, for example?
Yeah, the main difference. So high dividend income funds are relying on those companies that are part of the index or part of the fund to actually pay out their dividends on a quarterly basis. So we do that as well because any dividend that comes to SPY, we directly pay out dollar for dollar to TSPY shareholders. But we add to that by harvesting income on top with the option premium. So those are some of the additive benefits that we provide. And one thing that's interesting too is this idea of zero DTE or daily options has three really big benefits compared to traditional covered call strategies of like, let's say a 30-day expiry strategy. The first one is if you took the same risk on a 30-day strategy where you wrote an option at the same risk level out of the money, and then you compared it to the same risk level for a zero DTE strategy, but you just wrote that option every day over that same period, the premiums that you would get for that same risk are between 4 to 4.5% or 4.5 times. So from a risk adjusted returns perspective, it's significantly better by leveraging the high demand zero DTE options. The second thing that's really powerful is when you have a 30-day sort of strategy, you're stuck. You've got your strike price where it is, and no one can predict the markets. But when you're doing it daily, you have daily flexibility to sort of reset your strike point every day. And therefore, if there's a big spike overnight or it drops down overnight, you can actually reset your strike in order to take advantage and ultimately keep your strategy in the same risk profile. And then the third thing, which has been really big, and you can look at the performance history, like you mentioned, early August, there was that drop and then things came back later that week. We actually are true zero DTE option strategy where we write it in the morning after market open and it expires same day. And by doing that, we avoid overnight risk and we aim to do that. And the main reason is, when our earnings reports after market close, when are macroeconomic reports? They come out before market open. So instead of having to guess and ride that overnight or in the morning, we let the market adjust after the news, and then we can take our position, which really helps from a risk mitigation strategy. And that's why the performance has been what it's been. Over the last, we launched August 15th. We're beating the S&P so far by about 0.67%. So if you annualize that, about 8%, where we're going to take that and provide that in yield. But the total returns is a number to always look at. And so far, since inception, we've been beating the S&P 500, knock on wood, which is a very, very difficult thing to do in volatile times like this.
And one more thing here, under holdings, most of it is the SPY. As expected, you have about less than 1% in cash and
Yep.
just over or just under 70 basis points of a government bond. What is that supposed to do?
Yeah. So the idea there is just the cash that we keep. The targets that we have are exactly like that: 1 to 1.5% of cash, the rest of it in SPY. The
Mm.
cash is just there for operating reasons, and then every day over time we're collecting more income. So the government bond is just how, for money that's sitting in cash, we're trying to optimize and get more return, but still have it flexibly available from an operating perspective for the fund. That's the main goal of that.
Interesting. Well, where can we learn more about your work and this fund?
Yeah, go to TappAlphaFunds.com. Take a peek. There's some videos there that explain the strategy, where it came from. But it's a really interesting time when you think about the trajectory of interest rates. Jay Powell just spoke this week, and everyone's still projecting more cuts that are coming this year. There was a historic cut at the last FOMC meeting. And so one of the big questions that everyday investors are asking, they're asking, hey, if I can't get this from fixed income, the income that I need, where can I go in the market in order to sort of replace that income? And options-based strategies are a really interesting thing to learn about because it helps sort of replace some of that direct income that you get, but you still get exposure to the underlying market. So it's a balanced way to get a little bit of best of both worlds.
Any other products in the pipeline for TappAlpha?
We've got so we started the first flagship one on the S&P 500 just because that's been the gold standard index to sort of look at. Next will be the same strategy on the Nasdaq 100 called TDAC. We'll do one on the Russell, so the T-Russ. And then one thing that we're learning actually as we're getting this new product in market, we can have the exact same strategy on any of those indices, but different investors need a different package for it. So you can have the same total returns and take all those returns and keep them in the SPY shares and just watch the SPY shares and the NAV grow. And then you distribute the options income, which is a smaller percentage distribution. But there are some investors that are on the other extreme where they're in their, at that point in their life where instead of filling the asset balloon as you are, over time, when you retire, you're starting to empty it. And so we can actually take strategies like this, exact same total returns, we can increase the yield that is now provided to investors. So it would take the options income plus the S&P 500 capital growth, liquidate that, and then actually provide a much bigger yield. So we're looking at different opportunities to provide different packaging in order to sort of help provide different product options to different levels of investors, depending on where you are in your life cycle.
Okay, interesting. Thanks very much. Sai, we'll speak again soon.
Thanks so much for having me.
And thank you for watching. Don't forget to like and subscribe.